high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standards Banking Show, where we bring you the story behind the latest developments in the banking sector. It is the 11th of January and I am Ruchika Chitravanshi. In this episode, our cover story will talk about why Indian banks are on a fundraising spree. For the Banker's View this week, we have Parag Rao of HDFC Bank with us. In Banking for You, we will tell you all about RBI's guidelines for unclaimed deposits. Our consulting editor, Tamal Bandyopadhyay, will join us for an expert take on emerging trends in digital lending. At the end of the show, we will tell you the results of last week's poll and the question for this week. Lately, banks have been going on a fundraising spree and hiking fixed deposit rates to attract customers. Kasturi Akhil finds out what's behind the fact that more than 6 major Indian banks have needed to raise funds since December.
As many as 6 banks have raised the interest rates on fixed deposits since December 2023 to meet the robust credit demand that typically accelerates towards the last quarter of the financial year. Meanwhile, industry players believe that since banks have been grappling with tight liquidity conditions lately, fortifying the balance sheet before the end of the quarter was a tough nut to crack without raising deposit rates. While credit offtake has been high, deposit mobilization has been low. According to the latest data from the Reserve Bank of India, bank credit expanded by 15.8% year-on-year until December 15th, while deposit growth was at 13.3%. These figures exclude the impact of the merger between HDFC and HDFC Bank. Further, banks are majorly raising fixed deposit interest rates with tenures of less than a year. Experts think that market participants expect the RBI to start cutting the repo rate by the second half of the current calendar year, at which point the short-term funds raised now would have either matured or will be nearing maturity. Therefore, it only makes sense for banks to try to attract deposits at the shorter end by the next few months to bolster their balance sheets by the end of the quarter. So, all things considered, how long are banks expected to continue raising funds?
Earlier, what used to happen is that when the market rates and the policy rates were lower, a lot of flows was available with the banks. And after the rate hikes and with a pause in the interest rates hikes, the other way of central bank to control inflation and control the credit distribution, they've been kind of giving the liquidity in a deficit mode so that it doesn't fuel the inflation. So till the time we see the inflation being slightly higher or out of the comfort zone of the central bank, so I don't see a very long time liquidity deficit to continue, but it's likely to remain not in surplus but in the neutral or a little deficit mode. So it could be 2-3 months or 5-6 months. Nobody's guess.
Large PSU banks, including the State Bank of India, hiked interest rates for FDs with durations starting from 7 days to less than 1 year. Other major lenders include Union Bank of India, Bank of India, Punjab National Bank and Kotak Mahindra Bank, which have hiked deposit rates over the last few weeks. While these banks have largely hiked rates on retail term deposits of less than 2 crore rupees, by 10 to 75 basis points across various tenures, Bank of Baroda has hiked rates by up to 125 basis points. Bank of India has introduced a super special FD with an interest rate of 7.5% for 175-day deposits ranging from 2 crore to 50 crore rupees. In a bid to scramble short-term funds, banks have also been turning to certificates of deposit, which are short-term debt instruments. Business Standard had reported earlier that commercial banks had raised about 1.2 trillion rupees through CDs in December 2023. This is the first time in the ongoing financial year that CD issuances have surpassed the 1 trillion rupees threshold in a month. according to data from the Clearing Corporation of India. The liquidity deficit in the banking system was reduced sharply between December 27th and January 4 by over 1.4 trillion rupees owing to month-end government expenditures including salary and pension payouts. However, experts suggest deposit rates are likely to be higher for a long time as long as there is stiff competition for funds amid tight system liquidity.
Moving on, in an exclusive conversation with Business Standard, Raghu Mohan, Group Head of HDFC's Payments and Consumer Finance, Parag Rao, speaks about why he is optimistic about the growth potential in credit card space despite outstanding amounts touching 2 trillion rupees in April last year.
Welcome to the BS Banking Show, Parag. Good to have you here. My first question is, credit card outstandings have moved in excess of 2 lakh crore. Do you think at systemic level, this is a cause for concern?
RBI has been talking about the overall unsecured space, which includes credit card. Having said this, I think the overall unsecured space is more of the personal loan and the business loan category of products, which is significantly higher in terms of outstanding as compared to credit cards. I think the overall concerns on unsecured, which have been flagged off, I think are not really, I think they are proactive measures, if you may call so, seeing the kind of growth of the unsecured space over the last year and the trajectory which most people who are disbursing loans, I think the kind of run rate which is going. Okay, but credit cards is actually a much smaller part of this whole unsecured game. And I really don't see too much of worry in that space. For example, I think line utilizations on cards are still well within safe parameters. Incrementally, you're seeing the underwriting standards, of course, ever since the great global meltdown 2008, bureaus have started kicking in. There are multiple bureaus today. There are multiple other checks which issuers do. And the other factor is that if you notice in the industry over the last 4 to 5 years, you've seen overall revolve rates are slowly inching downwards, whereas the number of cards issued are going upwards. So a combination of all of these factors ensures that the right kind of underwriting is actually happening on the card space, and therefore I don't see any stress on credit card books.
Do you think compared to debit cards, the credit card universe still remains at around 80 million cards? Do you think if there's a rethink on the merchant discount rate, acceptance could go up?
Well, let me put it this way. You've seen, you made a statement saying that, the number of cards are hovering around the 80 million rate. If you notice, the growth from 45 million cards just about 2 years back to 80 million cards, I think has been pretty consistently going upwards. You might have seen a sort of apparently or optical slowdown in the last, let's say, 7-8 months, but that is actually attributed to the new guidelines which came in last September, the RBI guidelines, which really talked about, ensuring that inactive cards, either on the newly sourced book or even on the portfolio, are actually sort of removed from the portfolio. And hence, what growth you see is actually a net growth, because there have been a significant amount of cards in the industry which have actually been closed because these were anyway not contributing to spends or the book. They were inactive in the portfolio. The second thing which is also attributed to card growth, the card-based growth going, is the introduction of the UPI and the RuPay card, credit card linkage to the UPI program. That in itself in the last 3-4 months has brought in a significant number of cards into the ecosystem. And so that spells, both these factors, as I say, spell a good omen for the growth of the card industry. And you'll see the numbers sort of going up again back to the earlier growth level, post-pandemic growth levels. Credit card MDRs remain, okay? What you don't have credit MDR on RuPay debit cards alone. You have it on other network-issued debit cards. All credit cards, MDR is applicable. There is an MDR applicable even on the UPI link card program. And so therefore there is, I think, adequate enough leeway for for growth in the system, given the first two reasons which I talked about. So I don't see that as a barrier.
Okay. Do you think the UPI credit line can by itself become a challenge to credit cards?
The opportunity for growth in the credit card space over the next coming years, next couple of coming years, is I think significantly large. One key factor is this RuPay card linked to UPI program. It offers in a very seamless way issuers to be able to give access to close to 350 million transacting customers on the UPI platform, which is a direct to account platform. And therefore, the linkage, this program linkage actually brings to those 350 million people, okay, the opportunity to overlay credit on top of the on top of the UPI rates. Now, this in itself, brings together a great opportunity for growth in the credit card space. In a similar way, okay. If you look at it this way, the UPI Credit Line program, UPI Credit as we call it, itself will also open up significantly the opportunity to overlay credit on it. Credit cards ultimately will never be able to target the entire 350 million, but a significant proportion of good customers on this line, people will take credit cards. But the UPI Credit Line is a much simpler program in that pre-approved lines of banks are sort of linked to the UPI, and customers can on the fly avail of credit through those pre-approved lines onto their consumption patterns. So in the same sense that I talked about the UPI linked credit card program expanding the opportunity significantly for new issuance of cards, in the same way, we see that the UPI credit program only expanding the opportunity for credit. It is still vastly under-penetrated. So you'll have two programs effectively running on the UPI rails. One is the credit card linked program, and one is the pre-approved lines linked program. Okay, so as I see it in the near future, I'm not talking of outlier situations where there could be some cannibalization, but I think overall the market will expand significantly.
And lastly, do you think that with the merger of the HDFC twins, cross-sell can be upped in a big way?
Of course, the penetration, if you were to sort of put the basis together, the penetration of the respective products, whether it's the bank accounts, and take one example, bank accounts on the limited base, the home loan mortgage base, and similarly the mortgage on the bank customer base, I think the numbers are in the low 20s, 20 to 30% region. Okay, so we've got a 70% kind of opportunity available to cross-sell. And like I said, it's first, of course, the primary products of an account, banking account, and then the mortgage. But then when you expand it to all the other categories, in fact, some of the other products, the categories are much lower kind of penetration levels, credit cards being probably the highest. Okay, so absolutely, one of the key strong rationales of bringing together and having a combined customer base today, as we speak, of almost 80 million plus customers, is exactly the opportunity to cross-sell. And that obviously gives us a significant opportunity to deepen relationships, overall enhance the banking engagement of customers with HDFC Bank, the merged entity.
With fintechs having vacated the unsecured space, does it open up an opportunity for players like yours?
Well, obviously in an ecosystem where there are players, and if a reasonably large portion of people vacate the space for whatever reason, I think yes, the opportunity lies up, and I think in it itself, it resolves the issue or the concern which I think the regulator was voicing, and the rationale for this action which they've taken was exactly that, to say, hey, we have no problem or issues with growth, but we expect players who are playing in the liquidity space to sort of, lend maturely so that, you don't create overt bubbles or hotspots within the larger ecosystem. And so to that extent, obviously, I think the opportunity for banks in this space, regulated entities as we call them, is quite large in that space.
Mr. Rao, it was good having you on the BS Banking Show. We look forward to having you sometime soon again. Have a good day.
Thank you very much, and thank you for having me on the show itself.
The Reserve Bank of India has revised guidelines for classifying accounts as unclaimed deposits. This also includes measures to prevent fraud in such deposits and grievance redressal mechanisms. What are the new guidelines? Let us understand in detail in this report.
According to the central bank's new guidelines, the balances in savings or current accounts that have not been operated for 10 years may be classified as unclaimed deposits. The term deposits that have not been claimed within 10 years of maturity will also be classified as unclaimed. As of March 2023, unclaimed deposits of 42,270 crore rupees were lying with Indian banks. Now, these deposits are assigned a unique number called the Unclaimed Deposit Reference Number or UDRN and then transferred to the Depositor Education and Awareness or DEA fund of the RBI. The RBI said banks need to undertake at least an annual review of accounts where there have been no customer-induced transactions for more than a year. If there is no operation in accounts or deposits, the banks are now required to inform the account or deposit holders in writing through letters, email, or SMS that there has been no operation. Now, if the letters are returned undelivered or no response is received through registered email, the bank needs to immediately undertake an inquiry to find out the account holder's whereabouts. A contact must be made to the nominee or legal heir if the account holder is deceased. The RBI also said that banks must host the details of unclaimed deposits and UDRN which have been transferred to RBI's DEA fund on their websites. Now, the database needs to be updated regularly, at least every month. The banks that do not have their websites must make the above list of unclaimed deposits available in their respective branches. The database also needs to provide a search option to enable the public to search for their unclaimed deposits. However, the account number with unclaimed deposits, its type, outstanding balance, and the name of the branch shall not be disclosed on the bank's website. Apart from unclaimed deposits, the RBI has also issued guidelines to classify a bank account as inoperative. The RBI's guidelines also state that after the bank has reached out to the depositor or their nominee and there is no reply, the account will be classified as inoperative. However, for transactions, only customer-induced transactions will be considered. Standing instructions and auto-renewal instructions will be considered customer-induced transactions. The guidelines added that only a particular customer account would be declared inoperative and all different accounts and deposits of a customer need to be reviewed separately during the assessment. The interest on savings accounts will continue to be credited regularly, irrespective of whether the account is in operation or not. Indian banks open zero balance accounts for beneficiaries of central or state government schemes and for students who receive scholarships. Central and state governments have been having difficulty crediting checks for direct benefit transfers, electronic benefit transfers, or scholarship amounts in these accounts, as they are also classified as inoperative due to non-operation for 2 years. The RBI said that banks must segregate these accounts and not apply the tag of inoperative if these accounts are inoperative for over 2 years. The RBI said that such accounts and unclaimed deposits will be activated after updating the Know Your Customer details or KYC details. The banks cannot levy any charge on reactivation of these accounts and deposits. The central bank also clarified that banks cannot debit any transaction in an inoperative account without customer-induced activation. The banks must also prevent unauthorized access to these accounts' customer data. Further, banks may also impose a cooling off period on the reactivation of these accounts.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So banks would soon have to conduct an annual review of accounts without customer-induced transactions for more than a year if they are not doing so already. Have you heard of borrowers who take loans to buy themselves a beer, or a vendor getting a quick loan to get vegetables from the wholesale market? Well, that's the latest trend in digital lending. I spoke with our consulting editor, Tamal Bandyopadhyay, all about digital lending and its future. Here's the chat. Hi, Tamal. Welcome to the Business Standard Banking Show. This week in your column, you have talked about digital lending. Now, what are some of the broad trends that you're seeing emerging in digital lending? And I also wanted to ask you that conventionally, it is not regulated in the most conventional sense. So are there some areas that we need to be careful of when it comes to digital lending?
Yeah, thanks, Ruchika. Actually, it's a first-hand experience. In Kolkata, December, I found a group of young kids, I would say collegians, drinking beer, and is financed by a digital lender. And then I figured out from my friends in Delhi, yes, that's happening there also. And in Mumbai also, I see in slums, families do celebrate their children's birthdays buying cake from the digital lenders. So why do they do this? I mean, this is very convenient. The one part is the convenience, there's no question asked, no credit history, etc. Second part is this, the loan amount is very small. It could be 500, between 500 and 5,000, anything. No question asked given. So this is a very convenient part, and any banks would not give you that kind of loan. This is a very short-term loan. The loan tenure could be much, but these guys, pay off very, very, very quickly. It depends on their cash flow. But the interest rate is very, very high. It could be 30%, 40%, 60%, anything like that. Now, why would they still go? Because banks don't touch them. Banks don't have this kind of product. And second is the convenience part. You get it promptly. And the one hook that some of the lenders use is this: look, come on, take the loan from me and pay off. Then you build your credit score. And from there, if you have a good credit score, you can also get into the banking fold. But in the process, are these guys getting into a debt trap without knowing? That's the question I'm asking. As far as regulation is concerned, well, there is a lot of gray area, but are they unregulated? Not exactly, because there is no independent digital lender. Digital lending is only a platform. Nobody can use it independently. In a sense, the banks can have app for loans, or NBFC can have app for loans, or NBFC and banks, they can tie up with the digital lenders. But the digital lenders are not allowed to, keep their own books and take the risk. The risk is always the bank and NBFCs. So there is no independent digital lender as we speak in India. You could be an NBFC, which is absolutely digital. That's a separate story. But then what is happening, and when I say gray area, probably some of the NBFCs are renting out their NBFC license to a digital lender. And, they are probably taking a cut as management fee and all sorts of, this is the gray area.
Yeah. So, Tamal, digitization is the future. Banks are also digitizing. We keep hearing about loan apps and safety precautions and everything that they are taking. How will this space evolve in terms of so many things? Interest rates, for instance, that they charge. How do you see this whole digital lending space evolving?
Okay.
Instead of behaving like this traditional money lender sort of thing.
Yeah, so first is very important, you were saying about the interest rate. As far as interest rate is concerned, RBI does not have and does not want to have any cap on interest rate. We have the Usurious Act, I think 1918. It also does not talk about what is the usurious rate, what is the rate which is not accepted. Unlike in US, you have in different states, there is a rate cap. But in India, you don't have this. Usurious Act, if you find something is really wrong, then you can go to court. But again, not with the entities like RBI regulated. RBI regulated entities are free to charge whatever they want. Now, as long as I am a lender, I am charging you 30, 60, 100%, but I'm explaining to you why I am charging this, and you know the key facts and you know the annualized rate, and you are happy to take the loan, RBI cannot do anything about it. RBI, it becomes, and if I'm exploiting you, it becomes a law and order situation, etc. Having said that, Reserve Bank of India is keeping a very, very close eye on this. RBI is not sleeping. RBI has recommended, RBI working group has recommended creation of an entity called Digita, which will be a sort of giving a stamp of approval, like you have that ISO 2000, ISO 4000, those kind of things. The digital lenders, they should need a stamp of approval on Digita. RBI also is talking about a law to sort of, I would not say regulate, for this space, digital lender, which is lying with the government. So I think as and when the new government comes after that, I will see the institution like Digita. We'll see the new law also, and we need to have a very, very vigilant RBI, which the regulator is. But having said that, there are a lot of gray areas.
Talking of RBI, RBI recently did not allow the Federal Bank CEO and MD an extension of 1 year that they had sought. What's the story there? What happened? Why the extension is denied?
Yeah, you are exactly like a quintessential journalist. You are fishing for something, what is there. But, simple fact is this, how long a CEO can continue. It's RBI norm says that there are two options. One is 70 years and one is at a stretch 15 years. But you see, this is up to. It's not 15 years you cannot take for granted. Neither you can take it for granted 70 years. Aditya Puri held the helm for 70 years. Now, as far as Sam Srinivasan is concerned, he is completing 14 years, I think, in August. So the board approved another 1 year term, so which will take him to 15 years. It's a logical RBI can, because 15 years is the cap. Now, RBI is probably saying, look, you have already held the fort for 14 years. So why not give it a younger guy who will have a relatively longer tenure? So let's not get into 1 year business. Give us new names, and we look for somebody who will be at the helm for 3 years at least to start with. And it can be evolved. That's what typically in India happens, 3 years, then plus 3 years, plus 3 years. So 1 year, RBI is not comfortable. 14 years, if you have done a good job, then it's okay, fine. You have not been able to do something, then let somebody else come. So I'm not passing on any value judgment, but this is 14 years is good. Let's not get into 1 more year.
Well, that's consistency, and I think RBI is right in taking such a long-term view, as it is going to take for digital lending also. It seems it is on that track, and you said that it's keeping a close eye. RBI is not sleeping, and the working group that you talked about has talked about the stamp of approval that they may need. So that will be an interesting space to watch out for. Thanks, Tamal, for joining us again and sharing your thoughts.
Thank you.
It is time now for our poll results. Here's the question we asked you last week. Would you prefer the gold bonds to FDs? 67% of our respondents said yes, they would, while 33% said no, they won't. Several banks like the State Bank of India, Bank of Baroda, Kotak Mahindra Bank and others have raised interest rates on their fixed deposits in the recent week. This is perhaps because banks need to attract fresh deposits and manage assets and liabilities. So here's what we are asking you this week. Would you prefer investing in bank FDs over shares and MFs? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, and our website. That's all we have for you today. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by by the nation's trusted bank, SBI, the banker to every Indian.